All right, we are moments away from the start of trading. Of course, as we wait and see for NVIDIA earnings coming up tomorrow, you can see futures right now a little bit depressed. We had a rough day yesterday. Looks like it will continue today. Of course, the S&P 500 down about 0.3% pre-market with just seconds to go until those bells officially ring and the market opens. You can see on the NYSE, we have ING Academy on the NASDAQ. It's a community bank from Ohio. We're thinking of Matt Miller, Middlefield Bank, ringing the bells. Of course, as we kick off trading on this Tuesday, you take a look at where markets are opening up. You can see the S&P 500 down 0.2%. Big tech, those are yesterday's numbers, but you can see they were falling 1% yesterday. And as markets open right now and the board flips up, continuing that downfall today, down about 0.3%. And the Russell 2000, not too pretty for those small caps, currently down about 0.5%. But one stock specifically to keep an eye on right now, shares of Paramount falling. Skydance set to become the new owner of the media conglomerate. That's after Edgar Bronfman Jr.'s group dropped out of the bidding war after submitting a $6 billion proposal last week. Paramount now expects to complete this deal with Skydance in the first half of 2025. And maybe then, Shonali, we can stop talking about it.
Maybe then, maybe not, though, knowing how this has been going. Also watching shares of Supermicro also dropping. Hindenburg says it's shorting the company. Bloomberg is reaching out to Supermicro for comment. Supermicro now down more than 7% at the market open. We're also watching Cava because the restaurant chain's largest individual shareholder and a group of executives filed to sell shares. And remember, Cava has been on a tear this year. And since last week's earnings, 10 analysts raised their price targets by an average of 23%. Yet on that share sale, you have Cava now falling more than 7% this morning as well. Let's take a closer look at Cava with Bloomberg's Abigail Doolittle.
And this is the worst day for Cava, Shonali, going back to February of this year. So some significant selling, lots of mixed messages around this stock and the company. Now, if we take a look at the sale, I think that one reason that investors in the stock, retail investors, institutional investors are concerned about our tail selling. They actually sold a pretty decent chunk back in June. They sold 3 million shares. That was worth about $267 million. Well, now they filed to sell 6 million shares. That's about 8.6% of the equity float. Put into this, holding about 20.5% of the equity float, so a pretty significant amount. Investors wondering what's going on here. Are they really shaving? Plus, there were some of the executives within Cava itself, the Mediterranean fast food company, including CEO Brett Schulman, did also file to sell shares. However, before we start feeling too bad for investors in Cava, although it does, of course, depend on where you bought, if we take a look at these shares out of the IPO, this is really pretty incredible. So we think that of NVIDIA as being parabolic. If we go back to Cava's IPO all the way back in June of last year, in white here, even with today's dip, and technically this does not look good, this is a parabolic uptrend, the reversal. We will reverse it all the way well back below 400. Remember, 90-degree angle can't hold. But there is NVIDIA in blue, and actually above that, Sweetgreen, and then Chipotle down in yellow. So some of these newer restaurant companies, they're taking on the AI craze, Katie.
All right, there you have it. Abigail Doodle, thank you so much. And let's broaden out this conversation now with Dana Dioria. She is co-chief investment officer over at Envestnet. And I want to go to your notes because you write that earnings are cooperating, but the only notable company that is yet to report, of course, is NVIDIA. And that feels like a big but, to put it mildly, Dana, because NVIDIA, I mean, second largest company in the S&P 500 by market cap, move of 10% priced either way. What do you think the stakes are when it actually comes to this company?
Yeah, also a huge contributor to earnings, right, for the overall S&P. I mean, close to 5% contributor on the earnings side. So, yeah, there's no question that, we're past the FOMC meeting. That was sort of the big market-moving event that we were expecting. But the NVIDIA announcement coming is certainly going to be the next one that we can look toward. And, it's not just about, of course, NVIDIA itself, right, and the earnings contribution and, its market cap weight. It's, of course, a bellwether on how the AI trade is going. And we're seeing lately a little bit of a pullback on tech, right? The equal weighted index doing much better. And so I think, there's going to be always an NVIDIA, not only for the company itself, of course, but just for how well are we doing in this AI trade.
Well, you think about some of those big tech earnings that didn't go over so well in early to mid-July. And one of the criticisms, of course, was that basically they're spending so much money on AI and not getting anything back. But then you take a look at the companies that are taking in that money, and it's NVIDIA. I mean, 19% of their revenue comes from Microsoft alone. So those billions of dollars that are being funneled to AI, that just feels like NVIDIA's benefit here.
It is. And right now what we're seeing, of course, is that the AI craze is really sort of focused on the creators, right? If you will, the NVIDIAs of the world who are going to deliver us the components we need to use AI. We haven't yet seen AI in any way kind of break out into produce or user experience, right? And how, big companies pointing to our productivity increased dramatically. You get a lot of talk of AI in earnings announcements, and just for the sake of, hey, we're looking at this, or we've experienced some benefit here. But there's big differences in how companies are using AI, and we have yet to see a really big move in terms of just productivity increase or efficiency increase, or the benefits of AI to the users. And that's why so much towers on the NVIDIAs of the world now. But, these big tech companies investing here, they're self-funding, right? They can certainly afford to accept a little bit of a dip if they see the long-run thesis, and clearly they do.
It's interesting. We had a conversation with RBC's Amy Wu Silverman just a day ago, and she made this point that there has been such extreme bullishness in NVIDIA that even a little less bullish means that it could say a lot for the market, that people are excited, but maybe not as excited as they were when valuations were a little lower or when the market was a little less choppy. Now, at the end of the day, if that's the case, then is NVIDIA really a story that could prop up more boats and lift this market higher with it?
I think if NVIDIA does well, it does lift boats for sure. There's two things going on here, right? There's the short run. How is NVIDIA doing in this moment relative to expectations? How does the market perceive that? And when your valuation is so high, any little bump, 100%, right? In the short run, any little bump is going to be negative, not only for the stock, but for the market overall. That's a very different question than what is the long run thesis for AI? Are we well on our way? Is NVIDIA one of the companies, not the only company, but one of the companies that's going to get us to this huge revolution, right? And change in how we all do business. So, the short run, absolutely. They got to hit it spot on, right down the middle in terms of, the pitch, right? But at the end of the day, this is just a short run kind of a market, assessment of, have we overshot right now? It has nothing to do with the long run thesis here.
Well, that was my question. Why not wait? It's interesting. If you take a look at the Philadelphia Semiconductor Index, for example, just year to date, NVIDIA up more than 150%. It's really up 154%. To get to the next best performing stock, it's Coherent at about 80% on the year. Why not either look for stocks that are sitting at lesser gains, better valuations, or just wait for a steeper downturn to get in?
I think that is the right thing to do for the average investor, right? I think the average investor is, they're either, if they're passive, they're getting a ton of NVIDIA. Even if they're active, unless they're taking massive tracking error to the index, they have a whopping amount of these types of companies, NVIDIA's and, the big tech in their portfolios already. So 100%, and as we see the equal weighted S&P making new highs, all the more reason that, what you're asking, I think, is 100% valid, that for the average investor, tilting away from this a little bit is probably the smart way to go, even if you believe in the long run AI thesis.
Dana, we have to leave it there. That's Dana Dioria of InvestNet. We thank you so much for your time ahead of a very critical set of earnings this week. And of course, there's a lot of economic data this week as well. Now, coming up, we're going to talk to Bob Sloan from S3 Partners to discuss the market implications of NVIDIA earnings tomorrow. We're going to also talk about the market for going short here because, of course, you have some prominent names betting against some high flyers. We're going to talk about it next. This is Bloomberg. This is Bloomberg Open Interest. A quick check on stocks because we're having a tough tape today. We are seeing the S&P 500 holding on to losses today of 0.3% and deeper declines in the NASDAQ 100 of 0.6%. That small and mid-cap index, that Russell 2000, the once beloved index this year, now seeing some pain as well, 0.7% lower. Really that optimism around interest rate cuts fading in the market today, Katie.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Citi says to sell Hershey, downgrading the chocolate maker from neutral and cutting its price target. The analyst sees a challenging year for Hershey and says that its pricing plans for next year won't be enough to offset the high cost of cocoa. Next up, you have Seaport raising Cleveland Cliffs to buy. The analyst says that the firm is well positioned to respond to a down cycle in steel prices and adds that the upcoming conferences will improve sector sentiment. And finally, we have Morgan Stanley raising its price target on Coca-Cola to a street high of $78, naming it a top beverage pick as well, replacing Pepsi. The analyst says the soda giant is posting healthier volume growth than its peers and highlights the company's strong pricing power, Sonali.
And all eyes on NVIDIA this week ahead of earnings tomorrow. S3 Partners founder and managing partner Bob Sloan joins us, and his team notes that NVIDIA remains one of the largest positions in both the long and the short side of the market. Actually, the most shorted semiconductor stock with over 4 times the short interest of Broadcom. You write, Bob, tell me about this data that you're seeing here. What exactly is driving the short interest here? Do you understand if it's really about valuation concerns mostly? And do you think that short interest is sustainable given the run-up we've even seen this year?
Well, one of the things we've seen in our short interest data is the following. Shorts started the year at $13 billion. They're now at $35 billion. New initiated shorts along the way of $3 billion. So you have the most new initiated shorts in the semiconductor sector, NVIDIA, $3 billion. The largest by far, both in the sector and across the industry and across the entire market, total $35 billion. Persistence of short selling and new initiation equals high conviction. And I think the analysts that you've had on your show, I was watching yesterday and today, have been talking about a near-term momentum reversal. That's what the short interest is betting on.
And Bob, of course, NVIDIA has become more and more important to the market, of course, as that AI story really takes hold and this company becomes bigger and bigger. How does the short interest dynamics against the long side that we're seeing ahead of this earnings report compare to previous quarters?
Katie, it's a great question. So for the first time really ever, you can, by using our data, you can break down market structure. Now, who cares about NVIDIA? Everybody. If you're a passive investor, it's your second largest holding across the market. If you're an active long manager, it's your third or second largest holding across the market. If you're retail, it's probably your largest holding. If you're a short seller, it is the largest holding, largest bet. So everyone around the table has a stake in NVIDIA. And what our data is telling us is that the long holders are trimming just a hair. The passive investors are trimming by about 2%. The active managers about 7%. Short sale sticking in. So you see a little bit of long selling, persistent short selling, and that's why we think the market's set up for a near-term momentum reversing. These stocks are unicorns. NVIDIA, you don't see this very often where it's the largest long position in the marketplace and it's the largest short position. So it's happened maybe like 4 or 5 times in the last 30 years. And the reason why is because it's this incredible utility combination of high beta, high vol, high liquidity, and cheap to get in and out of, both shorting and long.
Bob, one thing we were talking about a little earlier as well that I'd love to get your insight on is NVIDIA has risen a lot more than what you've seen in the rest of the Philadelphia Semiconductor Index. So when you look at investor attitudes towards other AI-related companies, given the run-ups we've seen in many of them, do you see similar levels of short interest outside of NVIDIA?
NVIDIA dominates It's a third of short interest in the semiconductor sector, and it's the largest short, period, across the marketplace. The rest are just add-ons.
And it's interesting, of course, that dynamic that we've been talking about, that you have interest both on the long side and on the short side. You're seeing it, too, if you take a look at some of these leveraged single stock ETFs. You have shares outstanding both in the 2 times long and in the 2 times short products. So it's interesting to see that match up with your S3 data as well. And one of the narratives I remember, especially around Tesla, was that it's impossible to short. You just get burned and burned. How much money, just roughly speaking, have short sellers actually lost when it comes to NVIDIA?
Yeah, about $22 billion. And
wow.
So that's a great point. It's about high conviction, taking losses, but taking the pain and staying in the trade. And not usually you see with the Tesla, the difference was that you'd see older shorts get replaced by newer shorts and get taken out. We're not seeing that. There's a real persistence. And, there is some, I would say, maybe market euphoria is having dessert and it's calling for the check.
Bob, thank you so much for joining us. That is Bob Sloan of S3. And don't miss an exclusive interview tomorrow with NVIDIA CEO Jensen Huang right here on Bloomberg TV at 6:30 p.m. Eastern. And coming up, we're going to talk about IPO hopefuls. They're facing a tough choice. Take the leap and go public this fall, or wait until next year when risks may subside. We're going to discuss the dilemma next. This is Bloomberg.
All right, this is Bloomberg Open Interest. Let's take a quick check on stocks right now. Companies are itching to go public, but the market hasn't exactly been fruitful for that. You take a look right now, the S&P 500 down about 0.2%. The NASDAQ 100 even more, down about 0.4%. That's after yesterday's slide, of course, down nearly 1% yesterday, continuing to fall today. And the Russell 2000, things are getting ugly over there in small cap land, down about 0.7%. Of course, we're in that interesting vacuum, Shanali, after Jackson Hole, but before NVIDIA earnings and, of course, before the Fed's September meeting.
There's another window we're going to talk about also. It's that IPO window, because companies itching to go public face a really tough choice here. The fall IPO window is now open, and you can either take the leap with markets near all-time highs or wait until next year when risks around interest rates and the U.S. election have faded. For more on this dilemma, we're joined now by Bloomberg IPO reporter Bailey Lipschultz, who who has been writing about this dilemma all year long, and you look at what has happened this year so far. The companies that have gone public, even the ones that have hit potholes along the way, are still higher than their IPO price. Why not just take the leap right now?
Well, that's the big argument, is why not? If you look at Viking up 50%, you look at Lineage, the biggest offering of the year, raising more than $4 billion in the REIT space, up about 10%. Investors are being rewarded, but a lot of founders and boards raised cash in 2020 and 2021 at far higher valuations. So now you have to have that conversation about what are we actually worth and what kind of a discount do we need to give investors to buy the IPO so that we can talk about being up 40 or 50% as opposed to being, like a company that's like Rubrik, which is up 11%, even Astera Labs, who went public last year, which is closer to unchanged after almost doubling in its first day.
And so I get the thinking that, okay, if we're not going to go public by November 5th, maybe we just wait until next year. But you think about some of the risks on the table. Do you think that the landscape will have meaningfully changed in 2025? What's the logic there?
Well, when we sat down with the heads of pretty much every bulge bracket bank last year in November, the conversation was, 24, we're going to have 4 or 5 rate cuts. We're going to have some election risk that'll eventually kind of play itself out. It feels like we're having that same conversation. Yes, there is a timestamp for the election, so we will most likely be kind of moving on from that risk come January, February, and we are expecting, as you guys have kind of talked about, the Fed to cut in September, and potentially, at least when you look at the swaps market, potentially the next 5 meetings. But the big question is, will those interest rate cuts play out? How will investors react to a potentially riskier environment? And how does that impact some of the valuations that a number of these companies that have been waiting to go public, trying to kind of tease out what their actual valuation would look like? Their view is that they'll have a better kind of line of sight come March to May.
You kind of have to also think, I think, about who benefits if you kind of go public at top dollar, right? I mean, there's certain investors who do benefit, but plenty who don't. A lot of employees have stock in these companies that want to continue to see those companies do well. Is there a benefit, actually, to wait and see if valuation's correct?
Well, it really depends who's selling, and there is kind of just that argument that taking a perceived down round can hurt some egos and hurt some expectations, or even just hurt morale. If you raise cash and you're an employee and you are worth $60 billion and you go public at 20, then you're looking at your options saying, well, this isn't really what I signed up for. But on the flip side, if you go public and only sell a small chunk of your stake, and 6 months from now, if you're a private equity sponsor, you can start capitalizing, or if you're a company like Kava that's up 400%, that's a still hefty return that maybe when you went public at the IPO, you weren't as excited about that price and valuation, but if you continue to execute and don't have missteps, you're going to be looking better in the end.
All right, Bailey, like 45 seconds. We're talking, of course, a lot this year about that dearth of IPOs, but I thought this was interesting under your byline this morning, a SPAC. I haven't heard that phrase in a while. Yeah, let's talk about it.
Yeah, so Bob Diamond and Concord had launched 3 SPACs. This is the last remaining pre-deal SPAC, but no more, announcing plans to take Events.com public. So Bob Diamond, former CEO of Barclays, a lot of excitement around that name, and his firm Atlas. So this deal, which we broke overnight, is going to value the company north of $300 million, depending how you want to tease that out. But another SPAC deal in what's been a really boom or bust, primarily bust space in the last few years.
All right, Bailey Lipschultz, really appreciate you stopping by. Of course, he covers IPOs, equities, and everything else. Let's get you to the trading diary. What you need to be watching this week. Today, we get Nordstrom earnings after the bell, really kicking off a string of retail earnings this week. But the big event is tomorrow, of course, when we get earnings from NVIDIA after the bell. All eyes on those numbers. More retail earnings from Kohl's, Abercrombie & Fitch, and Five Below coming up on Wednesday as well. Thursday, initial jobless claims, and Friday, we get July's PCE inflation data. Now, coming up in the next hour, we're joined by Zillow's new CEO, as well as Mark Patricof. That's, of course, as the NFL votes on private equity ownership. This is Bloomberg. are 30 minutes into the U.S. trading day. Welcome to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off this week. And coming up, Wall Street remains on edge. Investors waiting for NVIDIA's high-stakes earnings report and a heavy slate of eco data this week. And taking the reins at Zillow, Jeremy Waxman joins us to discuss his efforts to grow the business despite a historically sluggish housing market. And are you ready for some football? We're going to talk money, power, and sports as the NFL considers private equity ownership, Katie.
And before we get there, let's get a quick check on these markets. Of course, 30 minutes into the U.S. trading day, as I mentioned. We're still in the red, but not by as much. The S&P 500 down about 0.1%. That's following yesterday's slight fall. The NASDAQ 100, a little bit more. Your big tech names down 0.2%, of course, after yesterday's 1% slide. We have NVIDIA earnings tomorrow. How many times am I going to say that? That, of course, could completely shift the narrative, but that's the setup right now. Meanwhile, you take a look at the bond market. 10-year Treasury yields a little bit higher, drifting about 4 basis points to the upside, Sonali.
Well, pretty interesting. We have some breaking consumer confidence data crossing the terminal right now, and surprisingly, confidence better than expected, at least on the top line. Bloomberg's Michael McKee's here to join us to break it all down. Mike?
Well, it's not just the top line. It looks like people are more confident in general these days. The Conference Board's Consumer Confidence Overall Index rises to 103.3. That's from a revised 101.9. The expectation was just for 100.7. So overall, that is good news. The Present Situation Index, based on current conditions, improved to 134.4 from 133.1, and expectations also improved to 82.5 from 81.1. So across the board, much better. Now, the couple things I wanted to look at here, and I'm just dialing down to the overall numbers, which I don't have right here. But basically, what we're looking at is an overall improvement in confidence. And we have said this before, doesn't necessarily mean people are going to spend more money, but it does mean that people are feeling a little bit better about themselves and the economy. And that is probably good news for the Fed.
All right, Michael McKee out in San Fran for the moment. Really appreciate your insight, of course, as we parse through these consumer confidence figures. Let's broaden out the conversation now with Ann Milletti. She is head of active equity over at Allspring Global Investments. And, you know, Ann, I was going to ask you about the economy, what the Fed is going to read into it. But then I saw this line in your notes. You write that while macro news is stealing the majority of the airtime, the micro or company fundamentals matter even more at this point. I think that's really interesting because it's a debate we have all the time. What is actually driving this market? And when you take a look back at the past few weeks of earnings figures that we've gotten, what's the message?
Well, I think the message is a little bit mixed. Certainly the reporting season at the top line looks, actually I should say at the earnings line looks pretty good, where companies are beating for the most part. I think over 80% of the companies that have reported so far have beat. But it's more important to us to look not just at the earnings line, but at the margin, at the top line growth as well. And there you're seeing a little bit more of a mixed picture. Also, you know, as you look at the outlook, which is the most important thing during earnings season, getting a chance to listen to the management teams and get their assessment of the outlook, that's a little bit more of a mixed picture too, just because there is more uncertainty and less upside potentially with margins.
Yeah, and you think about some of the huge numbers that these companies are putting up. I mean, NVIDIA tomorrow, by some measures, expected to see earnings growth, measures of earnings double, but that's compared to them growing by a gazillion % last quarter. It just feels like we could be setting ourselves up for disappointment, even though we're talking about huge, huge figures here.
Yeah, what's really interesting is we have this handful or maybe 2 handfuls of companies that have really put up incredible growth results over the last, year plus. And those have translated to earnings, to margin, et cetera. But we all know that that fast of a growth rate is really difficult to maintain, especially the larger the company gets. And so we do expect to start to see some deceleration of growth. And I think there is fear in the marketplace, that will happen, and that maybe some of these multiples that we see in these larger, technology names, mainly the Meg 7, maybe just aren't that sustainable. Earnings still could look good. Their growth rates could still look good, but it could be a deceleration from what we've seen. And that will cause some, dislocation, I think, in those names and cause investors to look more broadly at other names.
And at this juncture in the market, you are really looking at a market here that is figuring out which way to go. We are not too far from all-time highs, but we are struggling to reach them once again. Is there more upside risk or downside risk at this juncture?
I think that's the million-dollar question. I wish I had a crystal ball to tell investors this is what it looks like. I do think when, forget about S&P targets or, NASDAQ targets, et cetera. When I look across the board and I talk to our portfolio managers, what I really hear from them is there are attractive areas of the market. When you look at small cap relative to large, the gap in the multiples almost have historically is almost never been wider. We've started to see small cap outperform for a short period of time, and then that kind of gets pulled away. You see that across the board in a lot of different areas. When you have the Russell 1000 growth, the top 10 names, comprise 60% of a benchmark like that. It just talks about the concentration we're seeing in the market. And concentration, that does cause some areas of concern and some potential areas of risks. We saw that in the most recent sell-off. But what we're seeing more broadly in the recovery is a broadening out of the marketplace and a recognition that there are some areas of the market that are very attractive.
So you think about the broadening out and you think about why there's so much concentration in the first place. Think about the consumer worries as one of those fears underpinning a lot of that avoidance of certain sectors. And then you look at consumer confidence data like you do today, and you wonder, Ann, how much more good data do you need to become a believer in a bigger broadening in this market right now?
Yeah, it's a great question, and I think the real challenge that we have today is that there's some uncertainty in the outlook. We are in an election year, which is typically good for markets, but uncertainty over what tax policy will look like, what regulatory outlook will look like, that's uncertainty for even management teams that are trying to manage these companies. And so investors and even the management teams of the companies are a little bit, at odds about what could happen as we look forward. That being said, I still think, investors should stay the course. Equity returns historically have shown that if you stay invested, you will get rewarded. If you go back the last 12 presidential election cycles, 6 Republicans, 6 Democrats, if you've invested $10,000 in 1961, granted a long time ago, but the compounding impact of that would be that value of that money would have been $5 million at the end of last year. So again, regardless of the uncertainty, there are places in this market to invest, and you kind of have to ignore that macro noise and really focus on quality companies. And I think that's our sharpest point right now here today, both in fixed income and in equity. You want to invest in quality.
Well, it's a good reminder, of course, that history is on your side if you're fully invested in the market. But you mentioned that uncertainty, and it might go a long way to explaining why there's still $6 trillion sitting in money market funds. There's a great story on the terminal this morning, the headline of which is T-bill and chill is a hard habit for investors to break. And I'll toss that question to you. What is going to be the catalyst for money to meaningfully move off the sidelines here? Are we just waiting for meaningful Fed cuts?
Yeah, it was a great article, by the way. I read it this morning. And look, investors were excited to see 5% returns on a money market fund. It has been a decent place for short-term money to sit and wait. But we are suggesting to investors, we know that, given what Powell said last week even, that the Fed is getting ready to start cutting. And so our fixed income teams would suggest that if you're in fixed income markets, to start to extend duration, really start thinking about investing in bonds and lock in some of those longer term interest rates. And on the equity side, again, as we talked about, the historical returns are good. So I do think it's likely that move in the interest rate cycle that will get that money to move out of money market funds.
But how fast does it move? And at the end of the day, one other thing that a lot of investors believe will help move this market higher is that movement, right? Is that investor appetite to move out of the safe investments that are giving you a decent return here into more risky investments. But if the risk appetite is still so precarious right now, then how does that money really start to move?
Well, we'll start to get a little bit more certainty as we enter the tail end of the year. Certainly, again, it looks like we're going to get a rate cut in September, and then we'll get closer to the election. Hopefully, we will know who the president is in November, and we'll start to get a little bit more certainty around what the regulatory and tax environment will look like. And as we know, whatever the outcome, companies will adjust to that outcome. And that certainty will help, I think, start to get investors a little bit more comfortable with where they want to be longer term positioned. So I think it's going to take a little bit more certainty. We expect volatility to continue kind of through year end. And of course, I left out the macro as I focus more on the micro, but the macro data, we are not ignoring. It's certainly something our teams are paying close attention to. And I think the jobs data is something that is going to be critical not only to the Fed, but to us as well, to signal, how secure really is the economy, and are we at risk of a recession, and potentially how deep could that recession get if we are going to enter one.
Yeah, absolutely. A lot of focus, a lot of questions on the labor market right now. Good place to end it. Ann Milletti of Allspring Global Investments, appreciate your time. Meanwhile, the S&P 500 basically back to unchanged. Let's get a look at what stocks are moving underneath the hood right now with Abigail Doolittle.
It's interesting. Beneath the hood, another tug of war happening between the bulls and the bears on a macro level. We'll take a look at that in a moment. But first, we do have at least two idiosyncratic movers to take a look at. First, Insulet, the insulin device, medical device maker. These shares are popping as the FDA has approved one of their technologies. Kava, on the other hand, as we were talking about the last hour, the Mediterranean restaurant, fast food chain restaurant, these shares lower as significant major shareholders are selling significant portions of their stakes. As for some of that macro play that I was alluding to, though, it really seems to be another day of investors moving toward value. We have Eli Lilly and United Health Group higher. Eli Lilly, of course, now selling some of their Zepbound for a significant discount. United Health at a new record high. Apple right now flipping higher. It had been down more than 0.5% around the news that their CFO, long-term CFO, is leaving. Amazon down 1.4%, despite the fact that they have this new Amazon podcast, or the podcast. They are signing the Kelsey brothers for $100 million. Maybe that is a piece of it, that money, but that's sort of a drop in the bucket for them. And then the big drag for stocks today was the big drag yesterday, which is the chip sector. If we take a look at what's happening for the likes of Supermicro and Broadcom, lower. Supermicro Hindenburg has a short report out. And then the big one, of course, Shanali, NVIDIA, it had been lower earlier, now up 0.5% yesterday. It zigged and zagged. This is, of course, is all eyes on this NVIDIA until they report tomorrow after the bell.
Abby, thank you so much. Of course, that is Bloomberg's Abigail Doolittle. And don't miss an exclusive interview tomorrow with NVIDIA CEO Jensen Huang, right here on Bloomberg TV at 6:30 p.m. Eastern. More up next, more on Zepbound's price cut, the latest on Eli Lilly next. This is Bloomberg. Now to high interest, a look at what's making headlines around the world. SpaceX delaying the launch of a rocket carrying 4 private astronauts to space. And it's part of a groundbreaking mission aimed at performing the world's first commercial spacewalk. The launch was initially scheduled for early this morning, but was scrubbed because of a possible helium leak. The launch window is slated for tomorrow. And the infamous pharma bro, Martin Shkreli, once convicted of securities fraud, has been ordered to turn over all copies of what was supposed to be a multi-million-dollar, one-of-a-kind Wu-Tang Clan album. He is also barred from selling or distributing the album thanks to a federal judge's ruling. In 2015, Shkreli paid a reported $2 million for that album, you may remember. And Eli Lilly is now selling vials of its blockbuster weight loss drug Zepbound to patients for a discount as it tries to address supply shortages. Patients with a prescription can purchase a month's supply of a single-use vial through Lilly's website starting today. Zepbound is sold as an auto-injector pen, and with vials, patients need to fill syringes on their own, but it saves Lilly production time, allowing more patients to get the drug, Katie.
And let's take a deeper dive into that Eli Lilly story with the author. We're joined now by Madison Muller. She is Bloomberg's healthcare and pharma reporter sitting next to me on set. So I want you to square this circle for me because, okay, they're lowering the price. Won't that just boost demand and they're already struggling with making enough supply?
Right. It's a good question. The issue for Lilly, though, which maybe we've talked about on the show before, is the complexity of making these auto-injector pens kind of has bottlenecked supply. So that's been the issue for them. It's such a complex process that it slowed it down a bit when demand, as we know, has been soaring. For Novo Nordisk, the supply issue has actually been making the active ingredient that goes into this pen. Semaglutide, yes, exactly. You're a pro. So the problem's a little bit different. But for Lilly, this actually is expected to potentially be a positive to sales because they can sell more of the drug.
So what does this mean for the overall supply challenge? Because another thing we've spoke about before is in the race to get ahead on supply, Lilly has sort of been winning.
Yeah, exactly. I mean, I think this is another example. We saw Novo's shares fall this morning because they don't really have this same lever that they can pull when it comes to supply. I mean, doing something like this and offering vials isn't something that would help Novo when they just can't make enough of the actual drug that goes into those vials. So for them, they're still ramping up supply, building out more production capacity, as is Lilly, but they don't really have these same levers that they can pull on right now.
And let's talk about the competitive landscape, too, when it comes to pricing. Obviously, that has been one of the hottest button issues out there. Lawmakers, et cetera, everyone getting involved. You have Lilly lowering prices right now. What does that mean for Novo Nordisk?
Yeah, I mean, it puts more pressure on Novo. Lilly's drug launched actually cheaper than Wegovy to begin with. So Zepbound is about $1,000 a month. Wegovy's a little bit more. So you already had that dynamic at play, and now Lilly is offering this even cheaper version, which puts more pressure on Novo. It also puts more pressure on these copycat weight loss drugs that we've talked about, that people are seeking out these cheaper knockoff versions of the drugs, and now Lilly has this cheaper version that they're offering. So there's a little bit more competition happening there now, too.
Well, more on that. What does that mean for overall price improvements? We spoke to kind of a competitor yesterday to GLP drugs. We spoke to the CEO of Curax, and this whole idea of pricing is pretty paramount to someone like that.
Yeah.
What happens to the other drugs?
I mean, that's a good question. For Zepbound, it's actually not totally clear what's happening. We need to look into the data a bit more about how this affects average Zepbound price, because Lilly also did raise the price of a savings coupon for Zepbound either this morning or last night. They raised it by $100. So that's for people that have insurance, commercial insurance that doesn't cover Zepbound. It used to be $550, now it's $650. So there's a little bit of, kind of like a dynamic happening where Lilly's lowering the price, raising the price of the coupon. And so how that affects sort of overall prices is kind of unclear still.
All right, Madison, great reporting as always. Our thanks, of course, to Bloomberg's Madison Muller. On Eli Lilly, shares currently up about 1%, adding to a 66% year-to-date rally. Now, still ahead on this program, more on the arms race to sell pharmaceuticals directly to patients. We'll tell you about a new initiative from Pfizer in our Social Climbers segment up next. This is Bloomberg. All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Pfizer has a new plan to reach potential customers selling drugs straight to patients. The company launched a website earlier today that lets users schedule vaccine appointments or meet virtually with doctors. The website's called Pfizer for All. It's one of the ways that the pharma giant is trying to stem falling demand for its COVID products. Next up, Edgar Bronfman Jr. abandoning his pursuit of Paramount. Bronfman's decision to suspend his bid all but ensures that Paramount will be acquired by Skydance. The Hollywood studio reached an $8 billion merger agreement with Paramount last month, but that deal included a go shop window that allowed Paramount to seek other buyers. And finally, NFL brothers Jason and Travis Kelce today reaching a deal worth more than $100 million with Amazon for their New Heights podcast. The deal will run over 3 years, and Amazon's Wonder unit will have global distribution rights to all audio and video episodes. And you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. And Shanali, let's meditate on that a little bit. $100 million over 3 years, and this is after we saw that deal with Sirius and Alex Cooper last week.
And we could talk more about that, but what's fascinating here too, Katie, is just how Amazon has been using Wondery. You may remember they valued the deal at $300 million when they agreed to buy Wondery in 2020. And so this single deal with the Kelce brothers is a third of the total price for the podcasting platform, which is pretty incredible. It also comes on the heels of that Amazon NDA deal. So diving into that original content, intriguing but expensive.
I don't think I'm going to become a professional athlete, but maybe we should just become podcasters. I'm starting to think that we're in the wrong business here.
Would love to hear about this. I think we would do a pretty decent job.
Yeah.
Maybe a little bit lighter on the sports content, but you could explain it to me.
That's true. I am not a huge football fan, but I will say this podcast, the Kelce Brothers podcast, it keeps coming up on my TikTok feed. So I feel like a consumer of it. It's the same thing with Call Her Daddy. You think about all these different ways that social media has changed industries. I think it's been a boon for the podcast industry as well.
And for what it is worth for sports, I have just become a Packers fan, so hopefully that pays off for me this year. Anyways, let's get a check on these markets. It's been a tough tape. Of course, on light volumes, though, we have seen the S&P 500 now really turning green, but not by much. Light volumes once again, but we are pretty much flat on the day. The NASDAQ 100, that's an interesting little bit of a turnaround this morning, now up about 0.2%. 10-year standing out at 385 after that consumer confidence data. Now coming up, how many rate cuts will it take to reignite the housing market? We're going to ask the new CEO of Zillow, Jeremy Waxman, next. Fascinating conversation. Looking forward to that one. Stick with us. This is Bloomberg.
Bloomberg.
Jeremy Waxman, the new CEO of Zillow, inherited a company that's been grappling with a sluggish housing market. We're going to get a closer look at that market with Bloomberg's Abigail Doolittle. Abby?
It may be a sluggish housing market, but you wouldn't know it taking a look at this board. But these, of course, the two first companies, Pulte and D.R. Horton, these are new home builders. So that new home market, those new homes, that's very vibrant because existing home sales really super low, just a stagnation in terms of buying and selling, as those who bought on super low mortgages, 2%, 3%, 4%, don't want to sell. So there's not a lot of supply. And then, of course, Zillow, the online real estate company, buy, sell, rent, and more, over the last year, also higher, up about 13%. But you can really see this gap between these home builders and then a company that focuses on some areas of real estate that are a little bit more traditional. Let's really put it into the perspective, though, of rates, because this does appear to be the big story here. If we go back to the GFC, we'll see on bottom, this is the 30-year mortgage rate, and then you can see home building. Now, that, of course, was an unusual time period, but since that time period, as rates have stayed very low, home building taking off. However, right now, 7.3%, even home building, which has been pretty strong, a little bit of a struggle. If we were to put the existing home sales picture in here, it's basically down, down, down. So these higher rates influencing the real estate market for sure. Although, again, those stocks, they're really doing pretty well, Katie.
All right, Abigail Doolittle, thank you so much. And joining us now to keep the conversation going, I'm thrilled to say, in a Bloomberg exclusive, is Zillow Group CEO Jeremy Waxman. And when we say new CEO, we really mean brand new. You started on August 7th, and the reception from the sell side was very positive. This is a quote from Benchmark's Daniel Curnow saying that the CEO role transitioning to the man behind a lot of the underlying platform improvements and acquisitions. So there you have it. But with that being said, I'm curious, why now for Zillow for this change, and what's on your to-do list?
Why now is because the business is doing so well, and we're excited about the strategy ahead and the growth into the future. We laid out a transaction strategy, moving Zillow from an advertising company to one that is more focused on helping people actually buy, rent, and sell with Zillow and our partners a few years ago. And you're seeing the results of that strategy really bear out. Right, the last 8 quarters, we've outperformed the residential real estate industry. We just reported Q2 results that were 13% on the top line year-over-year growth, and we expect to grow similarly in Q3. And so you're seeing the results of that strategy work and work well as our housing super app, this integrated transaction, really gets into the hands of more customers. And so that's why we all felt so comfortable with this transition taking place now, because we're so excited about the future ahead.
So we've covered a lot of CEO transitions, especially in the last couple of weeks, it feels like. And it's not often that we hear that the role's transitioning because the company's doing super well. And, you know, looking through your earnings, your recent earnings, that definitely appears to be true. But then you take a look at the stock price for performance. I'm going to pull up 5 years here. Of course, you had definitely a boom during the pandemic, one of those stocks that really caught on fire. You're down about 72% from that all-time high that you reached in February 2021. How much is that on your mind? When you think about your goals now in this role officially, do you want to get back to those heights?
Our goal as a company is to grow our share of transactions. Many of us use Zillow every day. We love Zillow. We're on Zillow dreaming. And most of America knows us for dreaming and shopping. But very few folks who are on Zillow actually transact, actually work with our premier agents, our agent partners, get a loan from Zillow Home Loans, use our software and services and our great agents. That's our goal, is to grow our share of transactions. Our target is just 6% of transactions by the end of 2025. And our audience share is in the 60-70%. So our goal is really to convert more of that audience into folks who want to and can use our services to buy and to sell their homes and to rent and find their next place to rent. So that's really our goal and our focus. And if we do that, we know revenue will grow, we know company value will grow, and the company will be a bigger company over time.
Jeremy, it's no secret that when you are looking at a home in America, in many places, you're looking at a very short supply. You're looking at really high housing prices, let alone still relatively high mortgage rates if you were trying to buy a new home, move out of your existing home. So what does it take for you to make that translation, to get people to buy more homes? Is it expensive on your part also to really double down on that marketing to get people to choose you?
The housing market is challenged, especially for first-time home buyers. As you said, mortgage rates are high, which has squeezed their affordability, and home prices have come up sharply from pre-pandemic levels while inventory remains low and folks are locked into their lower mortgage rates. That makes it a tough market out there. That said, people still need to move. And so while home turnover is at near all-time lows, a little more than 4 million seasonally adjusted from a norm of 5.5 to 6 million homes that trade a year, folks are still moving. And those folks are starting their home search more and more online. They're looking for ways to do things more digitally. They're looking for ways to take a tour, press a button, schedule a tour the way you'd book a restaurant. They're looking for ways to get pre-approved digitally. So building the services for folks who can get it done sets us up well to help more of them when it gets easier for folks to actually buy and sell.
Have to ask also about the changes in the industry, just even at the granular level. There's this idea here now that the industry could change pretty meaningfully as commissions change as well, new rules around commissions. How do you expect that to play out?
Yeah, the changes that came as a result of a settlement, right, in the industry, we see as evolutionary, not revolutionary. And those evolutionary changes are great for consumers. They're really about helping buyers and sellers get more educated. Now, every buyer has to sign a contract with their agent, whereas before they might have or they might not have, depending on who they worked with. That's going to lead buyers to understand how the process works, understand what things cost.
But Jeremy, what does it mean for you? Can Zillow be making any changes to kind of lean into these new changes?
Absolutely. One of the big things we did as the settlement came out was we pioneered an agreement, a buyer's agreement with our agents. And so we led what we call a touring agreement. Our big focus is ensuring that buyers and sellers are in control and are empowered. And so it's really important for us to make sure buyers can make a choice, that they're in control. And so when they sign an agreement, maybe you sign a non-exclusive agreement first as you're shopping around and finding an agent before you move from dating to getting married to an agent and you sign an exclusive agreement. So we led the industry to pioneer what we call a touring agreement so that these buyers, especially first-time home buyers, as they learn the process, they are able to make the right decision for them. They can shop around and find a great agent.
It's like Hinge for homes.
Yeah, there you go. You should patent that one. But I want to go back to the rental market because you've brought it up a few times. And of course, Zillow owns Street Easy. I have the app. I just signed a 2-year lease. I'm on it every single day for whatever reason. But when it comes to the rental market, as we continue to muddle through this kind of frozen buying market, what activity are you seeing there?
Yeah, the rentals market is almost counter-cyclical to the housing market, and there's a strong tailwind, and there's a huge need for inventory to get filled. That's what's driving a lot of growth in the rentals industry broadly, and Zillow's rentals business is really booming. It's now 1/5 of our revenue. It was up 29% last quarter, and we expect that growth to continue. What's interesting about our rentals business is StreetEasy, Zillow, and some of our other brands represent the largest amount of supply for a renter, right? You are a renter, as you know, it's hard to find all the inventory. There's no national database out there. Well, we've been able to pull together the most listings, not just the big buildings, but the millions of single-family homes out there that are for rent, and that's driven the largest audience. We have the most renters coming to Zillow, to StreetEasy, to other sites to find their place. That's now what's attracting advertisers, these big folks trying to fill their buildings, and that's what's driving our revenue growth. We see that business continuing to grow. That's $1 billion+ business for us over time.
Wow.
So how do you think about the impact that the interest rate reductions would really have? At the end of the day, you're still sitting with many Americans with mortgage rates sub 4%. And so even a reduction in interest rates at this level wouldn't really help that issue. So what does the conversion rate look like as rates come down?
Yeah, I mean, every little bit helps. But I agree with you that it's going to take more than 1 or 2 rate cuts to really unstick the market because, as you said, it's really about getting those sellers who are sitting on lower mortgages unstuck and wanting to trade up. That's what helps bring supply online. And as they talked about before, it's really about builders building more inventory because we still have an inventory deficit in this country. So bringing more supply online from those two forces will help really alter the supply-demand imbalance we have right now, and that will ultimately make it easier for buyers.
Well, talk to us about the dynamic between prices and mortgage rates. This is a conversation actually we were having with Barbara Corcoran just a couple of weeks ago, that when we do get lower rates, how much pent-up demand is on the other side to actually push prices higher?
Yeah, there is still really strong demand from buyers and sellers. We track seller sentiment are you planning to list in the next however many years? And that's at an all-time high for how long we've been tracking over the last 5 or 6 years. And that just shows you how much folks have been staying in place waiting for the ability to move. And the buyer demand that we see on Zillow and in the industry broadly is still at very strong levels. So even as we get more inventory and affordability eases, you're going to see it push demand even higher, which I think will keep home prices elevated.
I hear really mixed things when I talk to real estate executives about the Biden administration's policies towards the housing market. You have Kamala Harris now, as she seeks the presidential election, proposing new home supply. People love that, but they don't love the rent caps. How do you think of these policies?
Yeah, the great thing about working at Zillow, we've been around for 20 years and we've worked with whomever's in the White House. The big challenge is on affordability, and we're really focused on consumer education. A big part of affordability is making sure people make the right decision for them, get a mortgage they can afford, make the right decision, and work with a great agent. The larger macro issues around bringing more inventory online and unsticking sellers need to flow through for the market to get back to those levels you talked about. You know, we're down at 4 million homes trading right now, which is close to an all-time low.
Jeremy, we thank you so much for joining us here in studio. Of course, 20 days on the new job, though a Zillow veteran, of course. That is Jeremy Waxman of Zillow. Now let's get a check here on the markets because we've had a choppy trade this morning. We are back in the green and at a higher degree now. S&P 500 now up more than 1%. NASDAQ 100 getting a lift of 0.3%. 10-year yield only hanging at around 384. A slight tick lower in yield, slight bid in that bond market at this point in time. Now, coming up, we're going to talk about the NFL holding a vote today that could open the door for private equity to get in the game. It's the last major league to do so in the United States. We're going to speak to Mark Patrikoff, co-founder and CEO, up next. This is Bloomberg. time now for the Wall Street Beat. The NFL is meeting today in a highly anticipated vote on whether to allow private equity firms to buy stakes in football teams. It's the last major league in the United States to allow for this type of institutional investor to buy in. The NFL is also expected to soon announce its list of private equity partners, and it's a list that may include, according to Bloomberg's reporting, Ares Management, Aug30 Partners, and Sixth Street, plus a consortium that may include Blackstone and Carlyle as well. We're going to discuss the ramifications now with Mark Patrikoff, whose firm Patrikoff Co. counts football giants Travis Kelce, Joe Burrow, and J.J. Watt as clients. And you see this from the perspective of the players. You yourself are a large investor. How do you think this is going to play out at the end and maybe change the game?
Well, it's certainly going to change the game. I mean, the NFL, if you think back to the beginning of the league, it was owned by wealthy people in smaller markets who had made their money during the industrial age, really, if you go back that far. And these owners had to change the type of person, the way they thought about the league as the appeal grew and the market grew and the revenue grew. So now you think about, and it was inevitable, by the way, this had to happen, these valuations. I think we read that Jeffrey Lurie wants to sell 10% of the team at a $7 billion valuation. What individual wants to put up a $700 million check for a business where he will have no control, no path to ownership, et cetera? So institutional ownership was inevitable. The question then is, once they come in, how do they get out? When do they get out? Since these funds typically hold their investments for 5 to 7 years. Who will be next to acquire their stake at those crazy numbers? And it seems to me that inevitably this will be a publicly owned industry, which can be a very good thing. It'll address some of the lack of minority ownership issues, perhaps on the board level and so forth. So, the league is going to change. And by the way, change isn't a bad thing necessarily, but the owners are no longer really wealthy enough to own these assets, or certainly they're not liquid enough.
Mark, let's talk about that liquidity, because the idea of an IPO of a football team, there are ownership structures out there that would hint to this being possible. The Packers, for example, has more public ownership. It's not like listed on the New York Stock Exchange. But do you think that you might see some in the near future? What type of time horizon do you expect that to start happening?
You're going to see it next. There's no other way around it. I mean, how many billionaires are there out there who are willing to mark up a private equity fund's investment? So, you'll have these 6 or 10 funds. They'll put each sort of a $500 million, say, per team. And that will help fund new stadiums, practice facilities, guaranteed contracts like the one Watson got with the Browns. They had to put $240 million in escrow. If 95% of your net worth is tied up in your team ownership and it's a liquid, how do you fund the evolution of the business? So, the private equity funds were a natural next step, and the way they'll get out of these deals, I think, will be through the public markets, which, as I said, earlier, I think is a really good thing in some respects. Over 50% of the NFL is minority, the players. We have no minority ownership, no controlling ownership. That's probably hard to address with only a couple dozen black billionaires around the world, and none of whom seem to be ready to step up and buy a team or interested. So, board representation will also perhaps mirror the community in which these teams play. So there are a lot of good things that could come from it, but it will not be such a closely held asset in a kind of foreseeable future.
Right. Yeah. Well, it'll be fascinating to see how that evolves. And I certainly look forward to covering that brand of IPO. It sounds like a lot of fun. But I am curious, based on your conversations, of course, you work with over 200 professional athletes. Many of them are football players. How do the players feel about what we're talking about when it comes to private equity ownership here?
Well, what's interesting is put private equity aside. Over the 6 years I've been doing this, we've advised over a dozen players on buying stakes in soccer teams, in different leagues, in women's leagues, in sports that are kind of adjacent to the NFL, with the idea in some cases of learning how to be an owner, so down the road they can actually step up and be owners themselves. I'm curious, though, as you think about some of these larger funds and these players making more and more money, some of whom are investors in these funds now, how that will impact life going forward for the NFL. I mean, all the rules are going to have to change. It's conceivable that if an NFL quarterback plays until his 40s and has made $500 million, $750 million in the field, that some of that money will be put into private equity funds, either through our deals or directly into the funds. And those funds will then be owning teams, perhaps teams they're playing against. So just like gambling has caused a lot of chaos in the NFL, for sure, this is going to cause chaos too. But at the end of the day, these assets are just too valuable to be owned by one person, and it's just a natural, course of evolution for the league.
And it's a good point there that you make about, will be issues to sort through here. And I mean, I'm curious, when it comes to the players themselves, would we expect to see salaries rise as if this goes through, where private equity can buy stakes, if we're talking about teams going public? How does that work potentially?
I mean, look, the salaries, I think the pendulum has gone from the owners being completely in control and making the vast, vast majority of the economics over the last, 50 years of the NFL, and it's swinging back towards the players. It's gradual, but if you look at the salary structure now and look at the amount of money, especially the quarterbacks with the wide receivers and other, pass rushers, that's going to continue to trickle down, and the players are going to get paid more and more as these valuations go up. As they get paid more and more, if they get paid more and more, they have more net worth to use to invest in the logical things that high net worth people invest in. Usually it's an asset class that you understand and have an ability to impact. So team ownership makes a lot of sense.
Mark, I want to ask you another question here, because before you started Patrikoff Co., you were a very prominent media investment banker as well. And now you see two football stars, two people you've worked with closely, Travis and Jason Kelce, inking a $100 million deal with Amazon. That is a third of what Amazon paid for Wondery, okay? When you see these kinds of deals, what do you think this means in terms of the potential for media rights in sports and these athletes to more directly monetize their value?
Well, first of all, I love the Kelce brothers, and when I met them 6 years ago, they have such personality and combined with great intellect, combined with both of them being Hall of Fame players, and the Taylor Swift effect certainly had an impact on this. But I think of it a little bit differently. I think of it more as you have Amazon, you have Apple, you have a new set of media, distribution partners who have other ways of monetizing those assets. So when you have personalities of that scale, the league has gotten so popular, both domestic and now internationally. There's a reason why they play games in Mexico City and Frankfurt, and Munich, and London. The ability to recoup the investment that media companies would make in personalities like the Kelce brothers is obvious, and it will continue to spread, but you still have to have the core ingredients that those two have, which is to actually attract an audience that and be entertaining and smart and so forth. So, but the cream rises and the personalities will get paid, and as the rising tide lifts all ships. If you're good at what you do on the field and you're good at what you do off the field, there are partners now who will pay for your time and attention on media platforms. It makes perfect sense.
I think it makes a lot of sense. I mean, I think it's telling that I listen to New Heights very casually, and I know next to nothing about football. So there you have it, Mark. We have to leave. They're very good. They're funny, and the Taylor Swift effect. It's real. Mark Patrikoff.
They're authentic. Those two are authentic, and people can see that now.
Yeah, the personality definitely shines through there. Mark, have to have you back soon. Really enjoyed this conversation. That, of course, is Mark Patrikoff. Now, coming up, the market-moving events you need to be watching. That's next in our Trading Diary. This is Bloomberg. All right, let's get to the trading diary. What you need to be watching this week. And today, we get Nordstrom earnings after the bell. Tomorrow is the biggie, as we keep saying. Earnings from NVIDIA finally, and more retail earnings from Kohl's, Abercrombie & Fitch, and Five Below. Thursday, some eco data. We get initial jobless claims, followed on Friday, that July PCE inflation data. We know the Fed will be watching very closely, and of course, market participants as well, Shonali.
Is it bad that I still feel like the Amazon Kelsey news is the biggest news of the week? Anyways, check on markets here. We are in the green now. Let's hope it holds for the rest of the day. Of course, we started lower, ending a little higher for this show at least. 0.1%, a little more than that on the S&P 500, 0.3% on the NASDAQ 100. But the big moment, of course, Katie's tomorrow with
Absolutely. NVIDIA, of course, we're waiting those earnings, as to Abercrombie & Fitch. And speaking of, coming up tomorrow on Open Interest, Fran Horowitz, she is the CEO of Abercrombie & Fitch, joining us again in the C-suite. Looking forward to that conversation. Of course, Abercrombie shares have been absolutely electric over the past year. But that does it for us for now. This is Bloomberg.
Everything. From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York and San Francisco, this is Bloomberg Technology. And there's change at Apple as the CFO, Maestri, steps back and the iPhone maker promotes from within. We have the details on Apple's new finance chief.
And Meta calls out the White House. CEO Mark Zuckerberg says the government pressured Facebook to censor their COVID posts during the pandemic, and he regrets giving in.
Meanwhile, the NFL, Kelsey brothers win big. A $100 million podcast deal with Amazon after Taylor Swift helps bump the audience. That and so much more coming up. But first, let's just check in on these markets because we're being whipsawed by one name and one name in focus, Ed, ahead of NVIDIA earnings. I know we're going to be digging deep on individual names with you, but NASDAQ 100 currently up 0.5% because of that name turning into the green. 2-year yield flat. In fact, we've got a big 2-year auction. 10-year yields have been moving some. Look, we're at the moment in a holding pattern before we get the key macro movement that is earnings tomorrow of NVIDIA. Bitcoin just off by 2.5%. Interestingly, after that ramp up over the course of the weekend, right, 61,800 is where we currently trade. But Ed, what are you watching on that micro?
I want to go straight to Apple. The stock actually now higher. It had been lower when the news broke that Luca Maestri would step back as CFO and his number 2 would take over because he's the guy on the call that gives the detail. Usually, we're going to get more on that with Mark Gurman in a little bit. JD.com, $5 billion share buyback, positive for the US listed shares. Why? It's a really tough environment right now for e-commerce in China. This is something that is shareholder friendly while the macro picture deteriorates. And we're going to get a bit more on that as well, Karen.
Yeah, because it is ugly out there for Pinduoduo, PDD, once again. Let's focus in on some that are trying to support the market, others that are hurting with Ryan Veselica. And Ryan, it really was a shock to the system that PDD wasn't doing as well as had been anticipated, that even the cheap stuff isn't selling in China. What does that mean from a broader context when it comes to China?
Good morning. Thanks for having me. Yeah, there's a lot of concern about the strength of the Chinese economy right now, and seeing a company like this, which is so tied to the consumer, seeing them really give a pretty tepid outlook, pretty cautious, is certainly a reason to have some sort of broader concerns just about the state of things there and what the outlook is for China going forward. We did see that stock drop, I think, more than 20% yesterday, and it's down a little bit more today. So there's just some broader concerns now about just the strength of, one of the biggest economies in the world.
So Ryan, the JD.com story is kind of a read-through one where they are trying to do something to, I guess, disassociate themselves with the wider e-commerce picture in China. And buybacks always cheer up investors.
Yeah, absolutely. And this, of course, comes after Walmart recently closed out its stake in JD. So there's certainly been some cause for concern for those investors. Obviously, they are trying to signal, still a focus on shareholder value and so forth. So yeah, $5 billion buyback, never a bad headline.
I am just really interested in ultimately the context of China and appetite to be buying into what are sold off names. What point do we get lured back in? Because we saw real volatility around US tech names at the start of August and people bought the dip. Why not in China at the moment, Ryan?
I think there are just some broader macro concerns about their economic outlook, whereas people are feeling a little bit more positive about the U.S. People are anticipating rate cuts. It seems like a lot of the major mega cap tech stocks here in the United States continue to post pretty strong fundamentals, pretty strong trends. AI remains a huge focus. And of course, the biggest players in AI are all here in the U.S. And that's just, it's a very easy decision, I think, for people to continue looking at U.S. names, continue buying U.S. big tech.
That picture tells the story as of this morning's session. Bloomberg's Ryan Veselica, thank you very much. Let's get a closer look at tech stocks this morning and think about the equity markets and what is a massive week. Denise Chisholm is the Director of Quantitative Market Strategy at Fidelity Investments. And there is this big macro event happening on Wednesday. I don't know if you've heard about it. It's called NVIDIA second quarter earnings. But what's so interesting is the timing comes after many weeks of very clear capital expenditures guidance. So you track that data and you ask yourself, what does it tell us? I know that you look at CapEx to sales and you might have a different story, Denise.
Yeah, I do have a different story. I mean, there is a lot of concern by investors around how much technology companies are going to have to spend in terms of CapEx, and that might be a signal of sort of the peak of the cycle. But when you look at the data for the overall technology sector, CapEx is just starting to pick up now. And when you look at CapEx relative to sales, it's actually declined over the last year, and it's in the bottom half of the distribution. I think that is the unique part this time in terms of technology. The free cash flow generation is much, much different than anything that we've seen in the past. So on that free cash flow generation, the stocks are actually still cheap on price to free cash flow on a relative basis versus the rest of the market, which actually cushions the blow to the extent that fundamentals have peaked and may slow. So some of that mean reversion might actually be priced in.
There is an index level discussion to be had. You know, I know that you don't track a specific name, but there's this fantastic chart, right, which shows that when the S&P 500 moves a percentage point in either direction, it's usually NVIDIA's fault. And the market, there's not much left thereafter. What do you make of that, the sort of dependence on that high concentration of single names at the index level, Denise?
Yeah, we have a lot of data on historical market concentration, and it's true. We haven't seen the market become this concentrated this quickly over the last year, or be this concentrated since, basically the 80s or the late 70s. But that concentration level in and of itself doesn't necessarily mean it's a negative signal for the market going forward. The market can stay heavily concentrated for an extended period of time. We certainly saw this in the 40s and 50s, which is not to say that that's the exact parallel. But I think what's more important to me, as much as there's been a bifurcation between cap-weighted indices and equal-weighted indices really lagging, I think that a lot of the signals that I'm seeing suggest that there might be a much more broadening out over the next year on a relative basis, where it's not just technology stocks being the dominant leaders, and the market might actually encompass more maybe interest rate sensitives and more cyclical sectors outperforming as well. I think the unique part of this cycle was around technology fundamentals. Technology fundamentals did something on an aggregate level that I've never seen in my database going back to the 60s, which is go from bottom quartile growth to top decile growth in under a year. Well, when that happens, that begets that relative outperformance we've seen. But as the starting point from this level, it doesn't necessarily mean technology will lag the market, as those cash flows and earnings growth might actually be durable, but it does usually mean that it makes room for other sectors to outperform as well.
What's so interesting, though, is how one-sided the market is on the single name. At the moment, analysts, 66 of them say buy NVIDIA, 0 say sell. But then I go to the S&P more broadly, and look, the price targets just aren't that many ahead of where we currently trade at the moment. We're at 56.28, and, well, most of the analysts actually see lower than that. So when we do give up leadership, so to speak, with the big tech names in the Mag 7, is it not going to be, if they lag, it won't be made up for by the other smaller players that suddenly do rally?
Well, I think you could end up in the situation where the big names just potentially tread water with a catch-up trade in the equal-weighted indices. I think that the big difference that investors are concerned about is what we saw happen in 2000, which is the MAGs, let's call it the Mag 7 this time versus that technology bubble last time, was going down on an absolute basis. When you're talking about just maybe lagging or hanging in terms of a relative perspective and growing into those multiples, I think that that's a much different story from a risk-reward perspective, and it sets up the rest of the market that really hasn't seen the earnings growth recovery that we've seen in those cap-weighted indices to still play out over time, which gives dominance to that equal-weighted potential or down the cap spectrum relative performance.
Ultimately, though, does technology still look like it will outperform to the extent that we've almost become immune to?
Look, I think it looks like a positive risk reward to me, and I say that because, A, after you've seen fundamental inflection like we've seen, the sector continues to outperform about 70% of the time because those free cash flows and earnings growth tends to be durable. And this goes back to the fact that when, in a lot of my data, 2022 looked like either a very soft hard landing or a very hard soft landing, but it did look like a landing. And if that was in fact a landing, then we are in the early to mid stages of what could be a multiple year recovery, and that includes in terms of technology earnings growth. So if you couple that sort of durable cash flow on the valuation disconnect, which is to say that they're still in the bottom half of the distribution of relative free cash flow, I think you have a positive risk reward.
Denise, very quickly, historically, when the S&P 500 gains double digits in 1H, it does well in the second half of the year. Will that happen?
That's correct. Well, I can't tell you if it will happen, but you know the math, which is a ball in motion tends to stay in motion. And it's all around the fact that usually the stock market gets it right. And by that, I mean it might actually be telling you something that you don't really know already, which is that more of the S&P 500 might be discounting a hard landing than you think.
Just such deep historical analysis. We love it. Denise Chisholm, thank you so much for joining us.
Always great to be here.
Director of Quantitative Marketing Strategy over at Fidelity Investments. Meanwhile, coming up, a closer look at Polaris Dawn. That didn't happen. SpaceX's first spacewalk mission has been delayed. Meanwhile, Ed, what are you watching?
I'm looking at shares of Walmart, a story that broke in the last 10 minutes. The company wants to expand its online marketplace. This is the digital platform for third-party vendors. You're thinking about competition with the likes of Amazon and Etsy, and what they're doing is just adding more stuff to it. Think about pre-owned watches, collectible trading cards. It's all part of an announcement they made out of San Francisco this morning for their sellers conference. Not doing much to boost the stock, up 0.3%. We'll track it. This is Bloomberg Technology.
Taking a look now at SpaceX, the company has delayed that launch of a rocket carrying 4 private astronauts to space, part of what was going to be a groundbreaking mission aimed at performing the world's first commercial spacewalk, known as Polaris Dawn. We want to get out to Bloomberg's Lauren Grush, who's been all over this. Once again, helium. It's a recurring theme with these space issues.
Yeah, helium is prone to leaking. It is a small molecule, so it can find its way out of various small crevices. But this just comes with the territory of following rockets and rocket launches. There's always some kind of delay, but hopefully it won't be too lengthy, and hopefully we'll see this launch take off soon.
They basically have a backup window every morning at the same time right the way through the weekend. So I imagine it will go off. A big part of this is not necessarily the crew of Polaris Dawn. It's the spacesuits. And you wrote about that last week in the Business of Space newsletter. Like and subscribe. Tell me about the spacesuits and why they're so key to what's due to take place in the mission.
Yeah, so for people who have followed SpaceX up until now, you might be familiar with SpaceX's so-called spacesuits, but the spacesuits that we've seen up until this point are really just pressure suits, which are used by the astronauts. They're worn when they fly to space, when they come back from space, and they're really mostly meant to be used in the case of an emergency, in case the capsule depressurizes or there's some unforeseen event. What SpaceX built for this specific purpose is a spacewalking spacesuit, and it's really meant to be used for this exact reason, for being able to leave the vehicle, perform repairs on the outside of a spacecraft. For this mission, SpaceX is just going to test out the durability of the suits, but these suits look pretty cool. They definitely look like the sleek white design of the pressure suits that we've seen, but they're supposed to be able to withstand the vacuum of space even better. They have heads-up displays inside of them, and they have the signature SpaceX style that we've all come to know and love.
I mean, absolutely fascinating as to whether or not we're going to be investing in, the new way in which we see the suits evolve, Lauren. Ed was just talking us through the fact that we're going to be seeing a new launch window every single day, but ultimately, how quickly can things like a helium leak be recovered from?
It's hard to speculate on this. I think when it comes to SpaceX, I am always amazed at how quickly they're able to kind of turn things around. If you recall, about a month ago, they had a failure with their Falcon 9 rocket while launching some Starlink satellites, and they were able to get back to launch within just a couple of weeks. So SpaceX has definitely garnered a lot of experience by launching so frequently. So it may be something that is easy to fix. With this particular mission, I don't think SpaceX wants to be taking any chances. It's probably one of their riskiest missions that they've done to date. They'll be going to a much higher altitude than astronauts have gone to in a very long time. So I think they just want to make sure everything is buttoned up. So it's possible they might take some extra care with this particular helium leak.
I mean, there is risk in this mission. 700-kilometer altitude, approximately, for the spacewalk. Only 2 of them will do it. And what I find so amazing is the crew's in quarantine basically right now, and yet Jared Isaacman's on Twitter or X saying, "Oh, don't worry, we know exactly what's going on. We're talking with SpaceX." He's kind of key to this because he went on Inspiration 4 as well.
Yeah, Jared Isaacman has definitely become an interesting SpaceX figure. He has bankrolled the development of this program and also helped to fund this flight. And he'll be flying again in the future too. He didn't just buy this one flight. He has kind of invested in an entire program, research and development program called Polaris. And this is just the first part of that. It'll eventually culminate with the first crewed launch of SpaceX's Starship rocket, which is that massive vehicle that they've been building in South Texas. I assume that Jared will be on that as well. We'll have to wait and see because we still have some development road to get through. But yeah, he's definitely become a dominant figure in the SpaceX community.
Okay, see you at 3:38 a.m. Eastern Time tomorrow. Bloomberg's Lauren Grush, maybe. Thank you. Another big story we're tracking is Apple. Longtime Apple CFO Luca Maestri will step down from the job at the end of the year, handing the role to top deputy Kevin Perek after more than a decade. For more on the announcement, we go to Bloomberg's Mark Gurman. I guess why? Why step back and why the number 2 getting promoted?
Yeah, I mean, this is really not that interesting in the sense that this has been long planned. Apple has been telegraphing this for the last year or so. If you recall, at the end of last year, one of Luca Maestri's top 2 deputies, Saori Casey, she resigned and then later became the CFO of Sonos. And to me at the time, that became pretty clear that they were preparing for a transition and that it was not going to be her job, but rather Kevin Perek's job. Kevin Perek had a series of responsibilities related to market research, financial analysis, preparation for earnings, investor relations, and then he picked up Saori Casey's responsibility over financial planning and analysis at the end of last year. He actually moved into her office at that time. And he has been the heir apparent for several months now to Luca Maestri. He had been shadowing Maestri. He had been working very closely with Apple's executive team and Tim Cook. So this is something that has been in the works for several months now. Luca just turned 60, right? He's been in the corporate environment. He's been a CFO for decades now. He's obviously made a lot of money at Apple. Luca actually, at some points in his career, has commuted many miles to the Apple campus. This is obviously a very tough role. It's not a role you want to be in for more than a decade, probably, with everything at stake. He took over for Peter Oppenheimer in 2014, so it made sense. The bigger picture here is you're sort of probably going to see a big turnover of Apple's executive team over the next few years. And this strategy where they're not really allowing these executives to fully retire and just, play golf or fly their planes or what have you, and have them stick around in a smaller role. This is now the third executive in a row in the last 4 years that we've seen do this. The question is, how long is Luka going to stick around in this new role? And then one thing I know investors are curious about Parek. Everything I've been told and everything that I believe is that he's ready for this role, and I don't expect any hiccups.
As you say, he's going to be overseeing information technology and real estate functions, we understand, but in that reduced role. Meanwhile, Mark, all of this is in the broader context of they've got to still be selling phones, they've got to be innovating, and September the 9th, we understand, is when we're going to be getting our eyes on the latest new phones.
Yeah, September 9th, the iPhone 16 line, new AirPods, new Apple Watches will all be introduced. And then we'll get the performance of how these phones did from Kevin Parek at the end of January during his first earnings call as CFO. And all expectations are we're going to see some decent growth in the holiday period over the iPhone 15 Pro. There were no major new Apple Watches a year ago, no major new AirPods a year ago. So they've sort of set themselves up for a little bit of a layup to give themselves some nice growth in the holiday period.
Mark Gurman, as always, we thank you so much. All things Apple. Meanwhile, coming up, a look at the top tech stories making headlines this morning, including LG weighing in a potential IPO for its India business. That's next. This is Bloomberg Technology. Time now for Talking Tech. First up, LG Electronics is considering an initial public offering for its India business, tapping a booming stock market to help hit a target of $75 billion in electronics revenue by 2030. Now here's what LG CEO William Cho had to say about the market opportunity in India.
In India, we boast #1 market share in every single product. So as you know, India is one of the fastest growing market in the world. And the India will be continue to be a key market for our growth. But it's not about just the product sales. We aim to be the national brand in India. So as a company who have grown and loved by Indian people, we understand we should grow with Indian people. Providing the product and solution which will make eventually their life better. And For the IPO, yeah, I understand there's increased interest in Indian market among global investors.
It's the first time the South Korean company has spoken publicly about an Indian debut, subject to persistent market and media speculation. Plus, Sony, well, it's raising its price of its PlayStation 5 in Japan by 19% to nearly 80,000 Japanese yen, or $550, almost 4 years into the console's life cycle. The surprise move comes even as PS5 sales actually slowed, and Sony is widely expected to refresh its offering with a more powerful mid-cycle revamp of the console in coming months. One that you're watching, I'm sure, Ed. What have we got coming up?
Okay, big story. Mark Zuckerberg alleging that Facebook was pressured by the US government to censor content related to COVID-19 during the pandemic. That story's next. This is Bloomberg Technology.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. Let's take a look at the markets. And the story here is very clear. Technology a big factor behind pushing stocks near to their all-time highs. The Nasdaq 100 up modestly, a few tenths of a percent. But NVIDIA is a big part of that. Up more than 1% in the session, up more than 150% year to date. But unbelievably, up almost 1,000% from its October 2022 bear market low. This is astonishing, and it's the story this week with earnings after market on Wednesday. We'll have special coverage, and we will speak to Jensen Huang. All eyes on it. Meta's interesting as well. Caro, give us the headline behind what's going on with Meta. It was a big one that broke last night. Backward looking, not doing much for the stock. It's completely flat. But this is a story that on social media and elsewhere, everyone's talking about.
It is, because CEO Mark Zuckerberg has been penning a letter to Congress where he alleges that Facebook was pressured by the Biden administration to censor content related to COVID-19. He says he regrets the company's decision to accede to the demands. For more, I'm pleased to say we're joined by Bloomberg's Aisha Counts. And this is to the Committee on the Judiciary of the U.S. House of Representatives. Why put forward this viewpoint right now, Aisha?
I mean, it's such a contentious time, right? We're going into the election. We're just a couple months away. Content moderation has been a topic of conversation for a long time, but it feels like even more so. Election policies have changed. Employees that do things like content safety have been fired or let go. And Meta has been taking a step back from politics and news. So the timing of it sort of makes sense to me as we head into the eve of a really consequential election. And it's almost like Zuckerberg saying we're not going to do the things that we did in the past during this election.
There are kind of two storylines here, right, Aisha? There's the allegation that Facebook was pressured by government officials, and then there's the admission of regret on the actions that Meta or Facebook did take at the height of the pandemic. What were those actions? What were the kind of things that the Meta or the Facebook platform did when it found certain content relating to COVID-19?
I mean, it was pulling certain content, right? If content was considered misinformation or misleading, it was either pulling that content. Sometimes there was a note that was directing people to CDC resources or saying that this has not been verified. It was those sorts of things. So it was a mix of labeling things, but then also some posts and content were removed, which, you know, as Zuckerberg said, he sort of regrets at the time. At the time, some people felt like that was censoring and voices were not being heard. And so there was a lot of things that were happening at the time. And again, like this sort of movement and moment in social media, a lot of these companies are pulling back from taking down content like that. They're either just labeling it and leaving it up altogether, or they're just not doing anything. So it's a very different environment than it was even just a couple years ago.
But still, governments push back on that, and we see what's just happened to the CEO of Telegram for the fact that they leave a lot of content unmoderated. We'll get into that in a moment, Aisha. But on the nuts and bolts of things, it was still Meta's ultimate decision on what to take down. It's just they felt that the pressure was unnecessary coming from the government, right?
That was one of the key things that I took away from it as well. Like Zuckerberg acknowledged, we made the decision, we took down the content, they have control over their own platform. They didn't like the pressure that they were feeling, but again, they did ultimately make the decision themselves, and the decision rests with them, regardless, right?
Bloomberg's Aisha Counts on a really top story on the Bloomberg today. Thank you very much. Let's keep the conversation going. Joining us for more on Meta is Frank McCourt Jr., Executive Chairman of McCourt Global and founder of Project Liberty, a movement essentially that aims to make the internet a safer place, but that includes on social media platforms. And Frank, let's start very simply with your reaction to Mr. Zuckerberg's letter.
Yeah, good to see you again. I think that we're at a really key moment here, and we have seen in the last few months a real the wind has shifted. There's a real change. You know, you saw Congress recently pass COSA with overwhelming numbers. There's huge judges ruling on Google and the antitrust. I think that there's a real sea change here happening, and people are fed up with the way the internet is being used and the way these big platforms are exploiting individuals. I see this, quite frankly, as a cynical attempt by Mark to shift the focus from from Facebook and Meta and Instagram and all of the different products of Meta away from the habits of Meta and the exploitive nature of the platform and the fact that it's surveilling millions of Americans to being a victim, quite frankly. And I think that that's not right. We should keep our eye on the ball here and what's really, really going on, and not shift this to a news story about Biden and Facebook being a victim. I think it's just not correct.
Well, Frank, should any administration have the power to, if the allegations made by Mark Zuckerberg in that letter are correct, have the power to put pressure on a specific company or social media platform to act on specific content?
Of course not, and nor should the platforms have the power. And this is the whole point of Project Liberty. And what we're saying is our information, our identity, our data, our information, our personal information. This is something that is in this day and age is our virtual being, is our personhood. It's who we are. Individuals should be deciding what gets, how their content gets used. We shouldn't be having these big platforms make these decisions. It's crazy, Ed, to have these platforms surveil us, scrape our data, and then and have this power. We of course, don't want the government to be able to do it. But do we want a few big companies to do it either? I think not. Yeah. It's just it's the same end result. We just don't. We want the power to come back to people. Enough is enough on this.
But people aren't always great, Frank, to be perfectly honest. And when I'm thinking what's happening in France with a Telegram co-founder and CEO, he did too little to help protect children, ultimately, is their accusation. They allowed the spread of child sexual abuse material. At what point and what line do you draw when the companies do need to get involved? That's such a hard one to fathom, really.
Well, Caroline, your question assumes that the companies are, in the first instance, surveilling us, scraping our data, collecting it, and then we're asking them to do something with all that personal information they have. I think we need to change how the internet works so individuals have the power and they have control of their identity and their data, and they're not manipulated. What comes to my mind here is that we're talking about censorship and how this all works, and it's these algorithms, which are so powerful. We can't be thinking of censorship in an old pre-internet way when this algorithmic behavior that and these algorithms that are applied to this massive amount of our personal data is in this exploitation is happening. Algorithms and censorship, they're at odds with one another. The algorithms are preventing us from actually having coherent discussions. What I think about is what Jack Dorsey said in Oslo in June. He said too much discussion about free speech and not enough discussion about the lack of free will.
And Frank,
we're all having this circular